Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster of Victory Fiduciary, and welcome to the last midweek update for the month of March already. Time just keeps marching on, and so I did happen to miss last week's update. Just life kind of got in the way, and so I apologize. We're going to get into quite a few things today where we're going to kind of just really talk about what the market has been doing, the movements we've been seeing, and frankly, not much has changed between last week and this week. So it probably would have been a repeat anyways this week. And so what I really have been looking at is just how the market seems to be struggling for direction. And so it's almost like the bulls and the bears are having a tug of war back and forth in terms of where are the areas that we're going to see strength, what areas of the market are ready to break out, what areas of the market maybe are preparing to cycle down and maybe cool off. And there really is no distinguishable true pattern right now. And because what we're seeing is that we're really just seeing the market just trade significantly, just choppy, kind of grind sideways, then have a pullback, then kind of have a significant reflexive rally. And then you kind of look at where we are, where we started at the beginning of the year, where we are now, and most areas are kind of like exactly in the same place. So there's been a whole, at the top of the market in February, mid-February, some of those areas were extremely extended, as you'll remember, as we were talking about the fact that small caps were extended over 3 standard deviations. Technology was super extended. Mid caps were extended. And if you'll remember, I said, listen, this cannot go on forever. We are going to have to kind of go into some sort of a pullback or corrective process, because where the deviations that we're seeing and the extensions that we're seeing, it's not sustainable. And remember, what I also said was that typically when these things occur, no one knows what the exogenous event is going to be to kind of trigger that short-term sell-off. And so for this year, you'll remember, it was rising interest rates that kind of happened unexpectedly, the fear of inflation and how that could cause things to become more expensive. The cost of borrowing money would become more expensive, which could really be detrimental, especially to companies that have been borrowing a lot of assets to kind of just keep moving forward and making new products. And so those are some areas. That's kind of why technology probably took such a big hit, especially at the beginning. But remember, technology was already completely deviated and kind of overextended and kind of like just shot up real fast, as well as areas like international. It's another area. And so we knew that it would come. It was just kind of like, when is it coming? How long will it take? And what will be the trigger? So remember, this time last year, it's hard to believe it's already been a year, we were kind of in the same situation rolling into February last year. Markets were pretty extended. The thought was there could be an exogenous event that's going to trigger at least a short-term pullback or correction. Little did we know, though, that a pandemic was brewing, and so when that corrective process began, it was swift and it was really painful, because it kind of affected the whole world market all at once due to just fear and these global shutdowns that were pending. And so clearly for this situation that we're in, while yes, markets have cooled off, we've seen a lot of volatility, we've seen huge up days, kind of huge down days. We're really kind of like back to where we started in 2021 at the beginning of January. I'm going to kind of show you, but I just kind of wanted to use that kind of almost as like our introduction, because I know that anytime we see corrective processes and pullbacks, they never feel good. So I never come into the office and watch the market and say, oh, good, I'm so glad that the Russell 2000 is finally coming back down closer to its long-term averages, because we've been extended. I mean, we still don't like to see it, but we have to kind of, from an intellectual and like a non-emotional standpoint, say, okay, this is kind of what needed to happen. Honestly, I feel that after some of the work that the market has done over the last 6 weeks, we are potentially in a healthier place to be able to move on and make new averages and let some of these other areas of the market kind of continue to run. I used the example before about if you had just ran 5 miles and you were exhausted, but you still had to run another 5. It's almost like the visualization of the market kind of stopping and putting its hands on its knees for a second, gathering itself, taking a breath, taking a pause, so that it could go on and kind of continue with running. And that's sort of where we are right now. So that's just kind of the intro that I wanted to get into. Something that's interesting, though, is that consumer sentiment, number one, has significantly improved for this month. So consumer sentiment rose from 90.4 up to over 109%. It's actually it is the swiftest kind of revision in consumer sentiment that we've seen since 2013. So this just means that people say, we feel good about the economy, we feel good about spending. Obviously, we've seen some stimulus now coming into the market, coming into the economy. Maybe not quite as much because there were some different limits in terms of who was going to be eligible than prior, but still we are seeing some liquidity, and some of that liquidity is making its way into the market. So even though we've seen this pullback kind of corrective process since the beginning of February, really hasn't changed investor greed at all. We are really still off the charts with extreme greed with investors here. We have extreme readings, and so just really means that investors are kind of still at the one side of the boat. And so something that we should take caution to, I think, is kind of interesting, especially because we have seen some of these areas kind of pull back fairly significantly and quickly, and yet it hasn't really seemed to change investor standpoint. Now, something that I thought was interesting as well, we talked about shorting funds back when we talked about GameStop 2 months ago and what was going on there. Currently, the short interest in the S&P 500, so that means that investors that are going out and buying contracts betting that the S&P 500 is going to go down in value, is at some of its lowest values that we've seen on record. So back 2000 was the last time that we saw short interest this low. And then we know what happened after 2000. Right after that, obviously markets had significant corrective processes for a long time, and I'm certainly not saying that that's what we expect to see here. Just think it's interesting that despite where we've seen, nobody's really willing to quite bet against the market yet. So it'll be interesting to see how that plays out. So what I really wanted to do today was, I feel like tech has gotten a whole lot of slack over the last couple weeks, particularly like tech has been hammered and tech has pulled back. Is tech cycling out of favor? What's going to be the next area? We've heard about energy and financials. And so I really want to kind of show you, though, really from the broad-based perspective, what's kind of happened. And so what I've done is I've taken some snapshots of some of the different indexes that we track. We're looking back at 6 months. And so you can see back in October, so remember, September and October was the last time we kind of saw 2 months of corrective processes, very much so like what we're experiencing now. And then you can see after that last correction that the markets really had a great run. So they took their pause, then they kind of took off. And so RSI here got very extended here particularly, and here again. And so here's the NASDAQ. So we talked about this 2 weeks ago, how we did violate that 50-day moving average. Then we came back up, kind of sat on it, came back down here again. So we've actually been kind of trading still below that 50-day. Now we'll see where we end up today with the ends of the market. Markets opened up very low this morning, and they have kind of rallied out throughout the day. And so most of the indexes were trading right about neutral when I started recording. This is actually Tuesday, by the way. I'm recording this one day early, so this is March 30th. And so we'll see. But again, nothing crazy to really be super worried about here. Again, just after it had the run that it had, not really surprising to see RSI here, relative strength, is in a much healthier place than we were before. So we will continue to watch that. Now, this is the Russell 2000. This is going to be small cap stocks. Now, this is one of the indexes that I was really concerned about, and you can kind of see why. So if you can see, this was our last decline back in October. And man, this thing just took off. And so it was right about here that I was really worried about how far deviated we were from our 50-day moving average. And, it's funny. So we came down, we sat right at that 50-day, and it did exactly what you would expect it to do, act as support, and it bounced off, and it bounced right back off, actually to make a new high, only to come right back down. We saw some pretty significant sell-offs. You can see here, it shows you the opening and the closing. We see that big divergence there, like right here. It shows that markets sold off pretty quickly throughout, or significantly throughout the day. And so we're kind of right up here, just sitting at that 50-day. Now today, markets in the Russell 2000 have been mostly positive, so we'll probably reclaim our place above the 50-day. But you can see, after being as deviated as we were from our moving average, we were just due to have a pullback. Here is our mid-cap index. Looks very similar, right? So we had our pullback here, and we just had another huge run. And then as RSI kind of got above that 70 point, which is typically our trigger point that, hey, we are way overbought here, we have to cool off. That's exactly what we did. Same thing, though, as what happened with small caps, just kind of hit its line of support, bounced off, came back down, hit support, bounced off, came back down. And so today, and then so we did close, we were above it for the last 2 trading days. And so, again, if you look at this, when you take it into perspective of what's actually happened, doesn't seem kind of as concerning. But you know, when we see these, especially if you track movements these days, when we see significant reversions for the day, it can be a little distressing. I mean, even as an advisor who knows, hey, these things have to happen for us to be able to go on and make new highs and for the market to be healthy, still never feels good. I don't like it. And then finally, S&P 500. And so the S&P, I would say the difference with the S&P is that, so we haven't seen some of the more significant reversions that some of the other indexes have seen, but that's also because they weren't quite as extended. We never quite got to the extension that we saw in the NASDAQ and the extension in the Russell 2000, the mid caps. We were extended for sure, but just not the way. And again, this is, you can see we also in the S&P got hit a lot harder back in October here. We broke below our 50-day before we were able to rally above. And so I wanted to kind of show you that this has been kind of a broad-based pullback where we've seen most areas of the market, especially the ones that had been areas of strength, kind of pulling us out of the pandemic and the 2020 correction. And so does that mean that since we're kind of going through this process now that we're cycling out of favor? Probably not. So we watch these things. We try not to listen too much to what the media is saying and what people are publishing unless it's the numbers, because remember, this is all rules-based. And so, yes, rising interest rates absolutely were kind of like the catalyst for this most recent pullback. But we knew that something was going to happen, some exogenous event that nobody knew was coming, was likely going to come and trip the market up, at least temporarily. And so this is very similar to what we saw in September and October. And again, the market kind of was able to recover its gusto and move on. And so we're never married to any area of the market. So when we see things and when we study things, we're willing to make changes if it seems like that's kind of what's supported. We also just try to always keep in the back of our minds that these are necessary movements in markets to be able to remain healthy. And so I know it can be uncomfortable. March, just so you know, February and March tend to be some of the weaker months for the market anyways. April, May, and June tend to be a little stronger, so we'll have to see. Something else that happened that I didn't mention before is that, you know, we're coming into the end of the quarter, so portfolio managers are currently in the process of rebalancing, reallocating. That can cause some volatility certainly at the end too, and so I think that some of what we saw certainly last week was probably just a lot of volatility of buying and selling as portfolio managers, again, we're just preparing for next quarter. So that's where we are. I think that in terms of just the relative strength in general of the market, I think the market is still showing signs of ongoing long-term strength, even though right now we've seen some pullbacks and we've seen performance kind of, I would say, at least stagnate, because we've definitely consolidated for this time period. And again, though, for long and intermediate, I think that the market is showing us signs of the potential for additional performance. So we will continue to watch, we will continue to monitor, and then report back to you if those numbers begin to change and we begin to think that maybe we are seeing some signs of kind of long-term cycling in or out of favor. So thank you for joining us today. Appreciate it, and we look forward to seeing you next week. As always, if you have any questions, my email is ashleyr@victoryfiduciary.com. You can always write me an email if you have a question, you have a comment about what we discussed today, or if you'd like me to bring something up at next week's video. I would love the opportunity to address that. Take care. Have a great day.